Hey guys, Andy Burton here. Welcome to a special podcast recording with my personal financial planner, Jeff Fratarcangeli with Fratarcangeli Wealth Management. Jeff is a superstar in the finance and financial advisor world. And man, you're going to really love this interview because I've learned so much from him. Between him and my financial mentor, they taught me so much about how to properly invest, on tax strategies, on just how to be really smart with your money and how to strategically create wealth over the long term. So I'm super excited to be able to share this podcast with you. And we had to do it on Zoom because Jeff lives between Florida, Michigan, and he works all over the United States. And this guy is literally one of the best. So I'm super excited to be able to share this podcast with you and enjoy.
Where we're at in a very critical, I think, crossroad of the world and the markets and just a lot of uncertainty, which in my experience, going back 3 decades, creates opportunity. If you have the stomach and the unemotional approach that's very tough to adhere to in this environment, it can be very rewarding given time, if you're patient.
So you built, how big is your team?
We have a team of roughly 30 plus professionals. Every day it seems to grow a little bit more, with over 250 years of experience in wealth management. And my personal start date was back in 1995. So this year we hit our 30-year anniversary.
Awesome. And you're a Michigan guy, right? Midwest guy.
Born and raised in Michigan, live in Florida and Michigan, offices in 4 states, Manhattan being one of the locations, Indiana. But our clients, Andy, are all over the country, as I know that many of your clients may come from different parts of the country as well.
Yeah, man, it's, I'm watching my own investment portfolio. It's pretty rocky right now. Is there, like, just right out of the gates here, what do you give people advice, right? Like right now that it feels a little choppy. I'm hearing some people stop investing. I've heard some people pulling money. What do you give for advice in today's market?
When it's usually the toughest, and we all like to quote Warren Buffett and one of the most respected investors of all time. He uses the term, when there's blood in the streets, that's when we invest. When people are running this way, we run this way, and vice versa. So when people are buying in an aggressive fashion, in a euphoric type thought process, that's typically when you want to get more conservative, as opposed to when most folks are fearful and acting upon fear typically causes sell-offs that are more indented than they should be. That's the time you typically want to take advantage. But the general rule, Andy, is if you're investing money that you may need within 3 to 5 years, you typically do not want to own an equity or any type of asset, versus if you know you have the time horizon to stay the course and add money to that, what you believe in is strong investment, then this would be an opportunistic time to take advantage when the volatility is spiked and heightened and the markets are in a, call it 10 to 20% sell-off, which is what we've been enduring since December.
Yeah. So does that fall into some of the key principles that you're practicing for your clients?
Time in the market, not timing the market, is one key principle. In other words, your time invested is going to be more powerful than you being able to time the market. I think the 3 major principles that I would say we've learned and executed upon for decades is, 1, understand the liquidity you need to maintain your ability to pay your bills and stay above water in an environment that maybe cash flows in a tight space. That's going to become very important. Having lived through the Great Recession, those that couldn't make it through couldn't recover. Those that made it through not only recovered, but became stronger from it. Secondly, maintain a diversified portfolio. Today's a prime example of that. You have all these, call it 7 stocks that we've been talking about. That magnificent 7 are not quite as magnificent right now as they have been. 12 companies really drove the S&P 500 for the majority of the gains, call it 80% of the gains in the last 2 years. If you chase those areas in a highly concentrated fashion and didn't diversify, you're hurting more than the markets are today. But if you maintain a diversified approach of quality businesses over large, medium, small, growth value, and exposed yourself to all of the industries and sectors accordingly, you're sitting in a positive territory right now in the market when the market's down anywhere from this year 2% to 8%. So diversification. And then finally, I would say dollar cost average, very popular term. And let's talk about what that means. That means that without emotion on a set day every month, you're putting your discretionary dollar amount that you've predetermined into the stock market in those, call it businesses that we believe in, so that if the market's doing this, you're buying more shares when the market's down, less shares when the market's up, and you're getting a better average cost of your basis, if you will, or cost of purchase. And those three rules of approaching investing have never, ever failed me in any market. So maintain the level of liquidity to get you through. If you're over leveraged, if you don't have enough liquidity, you can't stay the course. Maintain a diversified portfolio, and chasing the hot area that just worked in our industry typically isn't the approach that will give you the best outcome long term. And then dollar cost average. Those are the key three-prong approach that will keep you stable at all times.
Here's what I found in my own financial journey. I needed almost different financial planners at different stages of my life. And then there almost came like a point where I was like ready for you, where it was like, okay, I had a certain planner that helped me get to one point of my wealth. And then I needed someone that could help me with a different vision and a different style of financial planning. Like, for instance, I got put in some mutual funds where I don't know exactly what happened. They recalibrated somehow within it, and I get this huge tax bill, and the fund balance went down. So I got hit twice, right? How does it, like, real quick, how does that happen?
So what you're referring to are what we refer to as pooled investments. And they're just that. You're pooling your money together with other investors to go after a specific strategy of companies in many cases. And so when you pool your money together with other investors in a mutual fund setting, open-ended, basically what's going to happen is the purchases of the stock that could have been made prior to you entering into that pooled investment, you're inheriting the cost basis from whenever those stocks were purchased, regardless of when you enter. So you may be buying companies at this price when the purchase price of the underlying stock may have been made prior to your entrance, and therefore you're purchasing when the stock's at 40, and they purchased that same company when the stock was at 10, and now your cost basis is 10. Now, during the course of the calendar year, if they're buying and selling positions throughout the days that the market is trading, they could have sold something, captured a gain, and then at the end of the year, Andy, what they're doing is they're passing through, the mutual fund is passing through the capital gain to the shareholder. So you're going to get stuck with a tax bill when you didn't personally sell. Matter of fact, you're still invested. And regardless of what happened in that calendar year, maybe the markets were down, but they're selling a position that had been owned prior to the beginning of the year. And now what's happening is you're essentially paying taxes come April the following year on trades that were made that maybe, one, you weren't directly involved in the cost basis. Two, during the course of that calendar year, you may not have actually made money, but what's happening is you're essentially getting stuck with the tax bill that unfortunately no one loves, but especially in an environment where, one, you didn't even make the gains that they're forcing you to pay, and secondly, that given year you're facing a loss in your portfolio yet paying taxes. The reality of the situation is we would prefer in a more modern capability with cost of transactions being far more competitive than they were decades ago when I started, owning a diversified portfolio of individual stocks rather than pooling your money together with other investors. So investors that have $1 million or so to invest, they'd be far better suited in individually managed equities owned outright with your own cost basis rather than pulling your money into a mutual fund. Now, many of your listeners and your audience may be in retirement plans with their employers, and their only option in that case is to use pool investments. That's fine. That's the option you have. And in that particular case, you're not as concerned about taxes because that's your 401k. That's money that's growing tax deferred. So know that it's not always going to be, that's not a great place to be, like I mentioned, in a taxable or personal account. Like a 401k, I would say, Andy, is where that would be okay. I would be all right with that.
Yeah. Okay. That makes sense. So now a lot of our listeners here are going to be realtors. Can you talk a little bit about what is like a solo K or their own individual retirement plan that they can have within, say, an S Corp or their LLC? I've found by reviewing a lot of their tax returns, helping them when they're getting pre-approved, they're missing the boat on taking advantage of these plans. Can you talk a little bit about that?
Yeah. So when you're a self-practitioner, a solo owned company or a small business, and in this example of an S corp structure, you may have some employees on your books as well, but each case is different, Andy. But when you're looking to establish a qualified plan like a company 401k, for smaller companies, you can open up a SEP, which is a profit sharing plan, right? You can open up a call it solo 401k, which is what you're referring to, which is an individual company, a company that just has one employee, that will allow you to defer money pre-tax to the tune of, if you're pre, call it 50, 23,500. If you're post 50, 30,500 is the maximum you can contribute of dollar for dollar income. You could also do a profit share if you chose to. That would bring you to that $69,000 limit. So obviously you can put less in, Andy, but you certainly have the ability to put the up to $69,000 if your income level meets the requirement to make those type of contributions. But what are the true advantages of this type of plan is it allows you to put money away pre-tax. So keep in mind, if you're at the highest tax bracket federally, you're going to be at a 37% rough tax bracket. Every dollar you contribute, 30 cents would have been paid to Uncle Sam if it hadn't gone to this, call it solo 401k or something of the like, that's a qualified plan, which is a huge advantage. So you're paying yourself before you pay the government. And those are dollars that you're setting aside for the longer term retirement, which you'd have to meet a certain age requirement in order to take that money out without penalty. And that would be roughly 59 and a half that you can contribute, or excuse me, that you can take money out of these plans in the future and not be penalized for premature distributions. So there's some rules and regulations that I would want your viewers to talk to their advisor about. But the true advantage is the fact that you have the ability to put money away before you have to send money to the IRS for taxes. And it is allowed to grow tax deferred. It is extremely powerful. It's the most powerful investment tool towards retirement planning. And the first thing we guide anyone who's starting in the workforce, even at a young age, is to make sure they do a budget. They look at what their income is, what their expenses are, know what is left over, and identify that discretionary amount that they can and choose to put away towards their longer term objectives. The first objective being retirement. The retirement accounts like a solo 401k, like a company sponsored 401k or a SEP, fall into the category of where this type of benefit could be utilized. So very powerful, Andy. And I know it's a very complex topic. So I want folks to really talk to their professionals, like a financial advisor or a CPA, to get more clarity on how they can personally use that type of vehicle.
Yeah, I see a lot of younger agents that can be netting on their income $200,000, $300,000, $400,000 a year without setting any money aside. And I make it as simple as if you put 50 grand in your 401k and save 40% in taxes, that just saved you $20,000 in taxes, right? So
absolutely.
Yeah, so it's huge. So it really costs you 30 to get 50. Right?
That's exactly right. And I know you're from the state of Minnesota, which you have your state tax benefit as well. And if you do the math, you're at the highest tax bracket, you're absolutely at this 50%.
Yeah, it's super expensive, especially what I'm seeing. These younger earners that are working hard, making a lot of money in trying to create wealth, and they're trying to find a different way. They don't have clear direction, like on how to do that. What are you giving for advice right now on younger earners? You were just talking about budget, which I agree. Most people don't have a budget, and you got to start somewhere. And what advice do you have for the younger generation as they're staring at, inflation costs? They're staring at housing costs. Man, a new car costs 60 grand. Everything's expensive now. So what advice do you have for them as they're creating their wealth?
Live below your means, right? Our own country doesn't follow their own guidance that's appropriate, which is live below your means. Don't spend what you don't have. And so first step is to really build a lifestyle and a habit-driven thought process that says live below your means. You have a piece of paper, you have a paycheck, right? First thing you do is you rip it in half, right? You set it aside for long term. And the really wealthy people end up taking an additional half and putting it away, right? So you're identifying what your expenses are, okay? You're living below your means to the degree that you can carve out discretionary income to a larger degree. And then you're essentially putting yourself in a position where you're putting the monies into areas that have the highest degree of opportunity to grow for you. We talked about the retirement plans, creating a portfolio of blue chip companies that we believe are going to be here long term. And then every month, make sure that you take that piece of paper that carved out the money that you're setting aside, and then living off of this portion is the formula for success. And it's very difficult to do. Andy, we all know that with inflation and, wanting to live with the Joneses, if you will, and have things today that will take away from being able to have the things later in life. It's very difficult. And we have to get out of that pattern. And just creating a habit early on is something that I believe we can take for us forever. And things that you're doing for your clients, and what we're trying to do is educate as many people as we can. I'm a guest lecturer at the University of Michigan. I'm on the board of the education program for the athletes at Michigan. And I constantly deliver that message that I know you and I have been taught from our coach, if you will, as well. And we're just, paying it forward and getting these young people that are just getting into the workforce, get them into a habit of breaking the habits that our country has kind of led us to over the years. And, it's interesting. There was a article I read recently, Andy, that said that if a family gets a medical bill for $1,000 that they didn't expect, 97% of those families go into debt because they haven't created that liquidity, that emergency fund, or that unforeseen expense, and then rip that paper in half many times to allow them to save money. And the American dream is not going into debt. The American dream is putting yourself in a position that you can be in the financial driver's seat earlier than the rest of your colleagues at a similar start date. And I know that we're out there educating these young people as early as possible because they don't teach them in high school. They don't teach them in college many times. And so our role and our job is to pass along these messages that will give them the base and the habits that'll put them in a great position down the line. And I'm going to tell you, there's that unforeseen expense. It's not a matter of if, it's a matter of when, and it's a matter of how deep and how well you plan to be able to overcome that. And living through the great recession of '08, there were so many people that were just brought to zero and brought to bankruptcy because they didn't have that plan in place. So it's so imperative, just as much as it is important to save, it's important to have more, even before that saving occurs, to have that emergency fund set aside. Create habits. That's the key. It's a major passion that I have to get out there and educate these young people, because what we're doing today is only setting up our next generation for failure if we don't get them on the right path.
I agree. Just getting that 6 months emergency fund, getting that first step out of the way. And I think for myself and Justine, I lived in a duplex and I rented one side, and my overhead was $200 a month till I was 35 years old, making great money, right? And just stashing it all away. That's why I was able to start working with you, because we had just focused on saving so much for a long time, but we were a little late even to the party, right? And so what I kind of see is like this, almost like the tale of two worlds for millionaires. It's like you have these high earners, business people that are stacking the funds really fast and early, and all of a sudden, outside of the superstars, they might see people breaking that $1 million barrier in like 35 years old or so, let's say. And then there's the other group that takes to like 50, 60 years old. Okay. If we speak, so I see a lot of, and I see it all the time, actually, just met with someone yesterday about this. There's a lot of retirees, like they're getting 58, 60 years old. They have all these 401ks. They have all these, there's no one actually advising them. I'm amazed on how many clients I come across have $1 million, $1.5 million plus $2 million. They don't even have a financial planner. They've just done a really good job saving. What do you give those types of people advice on when all of a sudden it's like, they need to talk to someone?
Well, listen, there's a cadence as to how money should be invested. Okay. And it's very methodical. So the monies that you're going to touch absolutely last is where you can take the highest degree of risk due to the time to your advantage. Every major correction in the history of our country, if you look back to where the peak was and where the actual where the base or bottom was and how long it took to recover, Great Depression, Great Recession, .com, financial collapse, you name it, 9/11. If you look at any of those examples, Andy, and say, okay, if I was just invested in the general market without dollar cost averaging, and how long would it have taken for me to recover adjusted for inflation? And the answer is 4 years. So if you're able to make it through a 4-year time frame and you just were investing at the worst possible time, history's taught you, and history is a great way to learn how the future plays out. If I just had the ability to stay the course for 4 years or longer, I'm going to recover and then some, right? So one, make sure you've identified monies that you're going to be able to stay invested with for 4 years or longer. I use the 5-year rule. And then furthermore, have a cadence of where you take your highest degree of risk versus your lowest degree of risk. We already talked about the lowest degree of risk, which is your emergency fund, 6 months. Your highest degree of risk, it would be the vehicle that's going to have the most advantageous tax ramifications over time, like your 401k that grows tax deferred and continues to grow until you take it out, to the, contributory 401k, the account that you're contributing to, your retirement account or your solo 401k you're putting money into. So you're putting money into it and it's going to be the last thing you touch. And then maybe you're not putting money into it, but it's going to be the second last thing you touch, like your IRAs. And then your taxable accounts, that's going to be a little bit more balanced. You're going to access before the other two buckets. And then finally, your emergency fund. So by having an advisor and a cadence, you're going to be able to participate and be more opportunistic in certain vehicles, like your longest term investment and your most tax efficient investment. So having an understanding of which investments do fit that, call it requirement or description of being more growth oriented versus more balanced or more value oriented, and build a strategy accordingly. I know that you and I, Andy, when we meet on a quarterly basis or monthly, depending upon the desire of the client, we look at these things. We identify what each vehicle's doing. And if you're doing it right, you're not going to be happy about one or two of the vehicles that you're in, because that means you're diversified, because nothing works all the time, right? And you're gonna monitor that mantra of cadence of how the money's invested. And by having a seasoned advisor, they're going to be able to guide you on that front. Although I do look at portfolios that they're with advisors, and sometimes I don't see that to the clarity that I'd like. So having your work checked and having a cadence and working with the seasoned team and advisor would be the guidance I would provide you, but a little background on the approach that you would want to consider.
Yeah. You guys do a great job on taking into consideration the tax planning side of things. Have you even had times of when to harvest profits to offset a loss? How do you stay up to date on all these regulations and guidelines? And man, there's a lot invested into that.
Well, there's one thing you can't put a price tag on, and that's experience. So I've been doing it quite some time. My staff and my team have been doing it quite some time. You've been doing what you do for quite some time. And even though when we started in the business, we thought we knew everything, we know now that we didn't. So experience is very critical. And then surrounding yourself with the sharpest minds and having a network of professionals in other lanes or on the front lines of the investment world that you can emulate, learn from, and then have access to get feedback. Like I do these market updates periodically that I hope you've joined in the past, Andy, or watched our retape of, like we're doing today. And I just, I constantly leverage folks that are experts in different areas of the broader needs that we have to be prepared or understand what's happening at that time. So you be cognizant of what you know, be willing to ask questions to the people that might be able to add value to what you think you know, leverage other folks in different lanes or expertise out there so that in the financial aspects of what we need, we have people we can go to, and constantly be a sponge in learning, because every single day there's something to be learned. And we want to make sure that you are surrendering to the process, humble in the fact that you don't know everything, regardless of how long you've been doing it, and make sure that you're learning something every day that's only going to improve your tools and capabilities of delivering solutions to your clients. I know you do it in your lane. We take the same pride in our lane. And I'm sure the realtors that'll be watching us today make sure that they're experts in their markets as well. A new person on the block in real estate cannot pretend to know everything that's going on in every street in their community. It's impossible. But having an experience of time, having an experience of being out there in the market, in my world, your world, and their world, only prepares us to give the best possible advice relative to our clients' needs.
Yeah, totally. So you work with some very wealthy clients. I know quite a few of them. And I'm going to pick on one, and he puts everything in the public spotlight. So that's the only reason why I can say this. I want to be really clear about this. So my financial mentor, Rick, is over 100 million in stocks. And I know you have some of that. What do you see on people like that outside of, usually they just make a lot of money? Like, let's be clear. Like, they have to spin off a huge amount of income typically to have that much in assets. So what is the difference where you start seeing, you know, you got the millionaires, but all of a sudden there's the 5 million and then there's 10, 15, 20, like there just becomes a large gap that starts to happen. What's the difference between the two or three or four, you know, as you're going up?
Yeah. So you're how are you going to make your wealth? You're going to inherit it. You're going to invent something, or you're going to be self-made and you're going to be a grinder. Okay. You inherit it, you invent something, you sell your company, or you just grind it out. Now, every one of the clients I work with that are the, you know, call it top of their class. Rick is the top of his class because he's a grinder, self-made. He always brags about the fact that he has a PhD, a public high school degree. So he's really coming from bare beginnings, if you will, and he's done everything himself. And he's really unique. I don't see as many people outside the core that we're attached to doing it the way he does it. It's typically you start a company, you build a company, you're rich but illiquid, and then you sell your company, or you've invented something. I actually represent the inventor of Uno, so I do have some inventors. And then you have the folks that just are creatures of habit. We are creatures of habit. My dad was an engineer at Ford. You know, I was fortunate enough to have a scholarship for athletics coming into college that paid for my school. And then I was, you know, starting out with a couple of quarters in my pocket, truth be told, and starting wealth management. And you know, just got onto a process of creating a budget and saving money monthly, and just following a approach that we try to preach to folks today. That's the one way of doing it. If you're fortunate enough to be born on third base and you can pretend you hit a triple, great, but that's not happening in too many circles. And then, of course, you know, starting a business from scratch and growing it like you and I are doing, and grinding it out. But habits that are being created is the biggest. Having consistency of what you're doing and how you're approaching it, being able to make it through the unforeseen corrections and contractions of the economy. It's going to wipe a lot of people out if they're not prepared, like we talk. And then, you know, listen, having worked with professional athletes, having worked with self-made business owners that are now worth hundreds of millions, in some cases billions, having worked with the best of the best in sports that I've had the luxury of being a part of and watching the development, whether they're entertainers, whether they're athletes, whether they're self-made individuals like Rick, you know, there's a very uniqueness to every one of them. And that is just fractions, the little things that you're doing to separate yourself, whether you're the guy sitting there doing his budget every month with a piece of paper and a pencil, or you're, you know, monitoring your income and knowing exactly what your portfolio is doing, or you're working extra hard as a professional race car driver, working that much harder than the next guy. I had the benefit of golfing with not a client, but a gentleman who I've got to know over the years, Michael Phelps. And I asked him, I actually have a son who's 14 that's an outlier in swimming. I said, what separated you from the pack? First of all, I'll just tell you, he's a little off in a good way. He just is. I'll just tell you that. And I respect that. And all the people we work with that are that successful tend to be a little off or different, including you and I, Andy, let's be frank. And he said, you know what? Every one of the guys and ladies I trained with worked out every day, sometimes twice a day for 6 days a week. He says, not me. I went 7 days a week. And I did it for decades. I think he said 20 years. And we all know that he won by fractions. He became a gold medalist more than any other swimmer. I think it was 23 times that he won gold medals. I might be off. It might be 32. I apologize if I am. But more than anyone, he has medals. And he worked 1 day more a week than every other swimmer, which was 2 hours a week longer. He was in that pool. And here he is today, the best of all time. That's an example of Jimmy Johnson. That's an example of other folks that have that, call it best of class. And we know the people we've learned from are the same way in their own lane. So it's a unique environment. So what do you want to be? Do you want to be good? Do you want to be great? Or do you want to be the best? You choose, and then understand what it's going to take to hit those targets. Being good's still pretty good, let's be frank, but being the best is what I strive for.
Yeah, I love it. I love it. So I just thought about this June, I've turned in a personal budget for 156 months straight and had someone else give me feedback on that, right? So 13 years, do you still do that? Do you still?
I'll show you.
Right there, huh? Yeah, so 156 months straight, I've had someone else review my budget and give me feedback about it. And that's my secret sauce when people are thinking, what is it? That's it. It's having someone else advise me and give me advice. And you're one of those key people that do that for me. So I know we're running out of time here, but I just wanted to say, thank you for everybody that I've referred over to you.
Yeah.
Take really good care of them. And thank you for taking care of, Justine and Hendrix and I on our finances. And, I look forward to seeing where this is going to grow to.
I appreciate it, Andy. It's an honor to give back to someone that I respect, that has given us the confidence to be a part of their team. And also the biggest compliment we've ever had in our career and doing what we do is a referral. So if you refer us to someone you care about, that says a lot. That's the biggest, so everyone says, how do you get paid? Well, obviously we charge advisory fees, but the biggest way we get paid is when a client refers us business, and all of our business is referral based. And I will say this to everyone, and it applied to me as well, because before I had my first son, who's now 14, I didn't do a budget. It wasn't as important to me, because if I made a mistake, it would hurt me, no one else. Now I make mistakes, I'm hurting my family, I'm hurting my legacy. So it's off the table. But I will say this, you can't change yesterday. You can't necessarily do anything about what you did this morning, but you can do something about where you're going to do next and what you're going to do every day going forward. So whatever your patterns have been up to this point, it doesn't matter. What you have control over, that's what you have to target, and that's what you have to focus on. So what we do from this point forward, what we picked up from this conversation, what you're doing, Andy, to help your people, and what they do with that information and that opportunity is what they can change and what they have control over. So today, from this day forward, what do we want tomorrow and the next day and 10 years from now to look like? Because what we do now is what's going to change that outcome. It's not too late, never too. As long as you're breathing and you're on the right side of earth, it's not too late. And I appreciate the opportunity to share that.
Absolutely. So who is your target clientele? So for people that are watching this, maybe they're listening to you saying, wow, I might be interested in working with Jeff. Like, who's your target market that you'd like to work with?
Well, I mean, we just like a growth stock, we look for the opportunity to be a part of something that's going to be bigger, that's needing our sophisticated guidance. So it has to be the challenges we're looking for. And then furthermore, we're going to help everybody. There's not a person. I remember where I came from. I remember the humble roots that I started in. My grandparents came from Italy. My grandpa was a ditch digger. My other grandfather drove a gasoline truck for Sunoco. So we came from really the salt of what made this country what it is today. My father was an engineer. I had uncles in both sides of my family that were very successful judges, doctors, attorneys, et cetera. And we always strive to take that to the next level, but we remember where we came from. So I'll help anybody. If someone asks us, I have a deep enough staff in our independent practice that I can help anybody. Doesn't mean we're going to take them on as clients. So I just lend our services and our experiences to help anybody. But we have a, targeted minimum that the relationship can grow to, right? Like a growth stock. And we have to have a level of sophistication that is needed, that our history and experience and capabilities can help deliver. Otherwise, it just simply isn't for us. So I guess the takeaway is we'll help anybody.
Thank you very much. And I appreciate your time.
Always. Appreciate you. Take care.